Hello, and welcome back to this episode of No Free Lunch, Economics for a Fallen World. Professors Guernsey and Heyman here. We're continuing to talk about some concepts in Chapter 16 of Finance. And Dr. Heyman, efficient market hypothesis is something that you spend a few pages talking about.
Sure. I actually have a love-hate relationship with efficient markets hypothesis. The basics of efficient market hypothesis is undeniably true. Markets are very efficient at processing information and taking that information into account in the valuation of assets. So we've got many data sets and papers have been written on it. They're even more efficient today, but even 20 years ago, you would see markets move within 5 seconds of new information being publicly announced. And we have some quantitative firms in Wall Street that actually have moved and made their location to be slightly closer to Wall Street, and they actually buy different equipment. Even they're outracing the speed of light so that they can trade faster than their peers. I mean, these are kind of the craziness about how fast information is processed. And that's not new information per se, the latter part. They're typically just having algorithms that are going faster than others to try to take advantage of those short-lived profit opportunities. So in that sense, markets are very efficient. And there's implications of that. When somebody gives you the hot stock tip, what do you do, Dr. Guernsey?
I tend to run the opposite direction.
Yeah, and you should have a long time ago, but when somebody was writing a newsletter and they said, this is the stock to buy, usually the information, whatever inside information they think they have is already priced in the market. B, they're usually pumping a stock they own to get people to bid it up, and then they're going to unload there's other things. So what's the implication for personal investment? What should a college student be doing right now?
Yeah. Now, the textbook, you unpack the different levels of EMH, efficient market hypothesis. I think it might be beneficial just to spend a moment to talk about those. This is an example of how economics and finance really do relate because it's an economist that is attributed with really developing EMH and publishing it and so forth. Eugene Fama from the University of Chicago. He did win the Nobel Prize for this and some other work that he did. But Fama said that there are perhaps 3 levels of market efficiency. And before I get into those, we should talk about, it does not mean that all markets are equally efficient. We could argue that one stock maybe is more broadly followed, so maybe it's a more efficient market than a small cap stock, and maybe it's not followed as much and so forth. But so Fama said the following. He said markets could be at least weak form efficient, and that means that past price behavior doesn't predict the future. Or some would say, well, a stock appears to move in take a random walk, if you will. So technical analysis doesn't work or doesn't give us more than an average return would be the implication. The next level of efficiency, semi-strong, is that all publicly available information gets built into the price of the asset. And we typically think of stocks, but it could be other things. And it gets built into that price pretty quickly.
So that would include like expectations of the future that everybody's talking about.
Oh, absolutely.
Okay.
Yeah.
Not just past data.
No, I mean, probably a really good example would be a particular company, overnight some good news comes out. It's their earnings or their prospects or something in the economy happens that people think are going to be favorable. And that should tend to get reflected in the stock price pretty quickly. If that's true, then by the time you and I find out about that information, it's probably too late, because there's a sense, tying it back to what we talked about earlier about cash flows, there's a sense that future cash flows are going to be higher, therefore the present value of that asset should also be higher. And it does appear that many stocks, publicly traded stocks, do behave at least or abide by or meet the semi-strong criteria. Now, having said that, I think you mentioned in the book, but Warren Buffett basically uses publicly available information, and he seems to do better than anyone else. Well, perhaps he's just more talented at using the same information and understanding what it means.
Well, Eugene Fama would say, no, he's not more talented. He's just lucky. He would say, in the broad distribution of all the investors, you'd expect to have somebody to get it right for 30 straight years.
Right. Yeah.
So that's in that as well. But what's the problems of this? There's a couple problems we have with this. But we never answer the question. I'm not going to let him off the hook. Don't worry, you've been asking, what should they do with their investment dollars? What should they do, young students?
Okay, so third level of market efficiency is strong form efficiency. And this is if a market for a particular asset is strong, then even private or inside information is already embedded in the price of that asset. And most studies show that there are not many markets that rise to that level. Really, insiders can benefit from information that's proprietary or that they have that others don't. And there's lots of examples of that, of executives trading on stock, et cetera, before good or bad news, and so forth. So, all right, to your question, what should investors do? Well, unless people are as smart or smarter than Warren Buffett, I would suggest that you perhaps can't routinely or consistently beat the market. So perhaps a implication of that is to invest in a way that you're perhaps satisfied with the market return, and you do that in a low-cost way. So some people like Burton Malkiel and others would say, well, just invest in index funds because you by yourself are not going to do better than the market.
And what's the data say? Do index funds typically outperform managed funds on average?
Most money managers that are managing active funds do not do as well as the market.
Because you have to pay their fees, and on average they don't. And if you think about it, on average they can't beat the market because the market is the average. So managed, the implication is as Dr. Guernsey suggests, if you're young, a low, I can't even say it.
No load fund is what he's saying.
For an index fund of the broad market of whatever you want to invest, seems to be about the best strategy. Now, here's my criticism, which is what I wanted to get to. Efficient markets kind of have this corollary where people think, well, hey, because you can't beat the market, they say, that the markets are always right. No, they're not right. And this is, Eugene Fama denies, for instance, that there are such things as bubbles. That you could have the overall value of an asset could be significantly disconnected from its fundamental asset value, from a formula we had in a previous video. I think pretty much, certainly myself and most observers think, yep, you can have bubbles. There are times of market, quote, irrationality, because what happens is what may be privately rational for an individual actor who thinks that they're going to move faster than the others is collectively irrational. So we tend to get these bubbles. I would assert, as from an economic point of view, that typically happens when the Federal Reserve provides excessive monetary stimulus to the point, but we do seem to get bubbles in there. And those also, the idea is there's always the right price in there. No, we don't know. It's what it is the market's very efficient at taking all the information and getting everybody's estimation with their ability to invest, i.e. they've got to have the capital. It's clear that there's always an equal number of bears and bulls on either side of a value. But it doesn't mean that they've come to the right answer, and that's why we can see some significant changes in valuation that certain members that will be on the side of whichever direction moves. Well, I told you all along it was that. But so it's not necessarily new information. It's just now there's more people coming to the conclusion that the information that was already out there should be viewed differently.
It's expectations or perceptions, like you say. Yeah, maybe it's putting a finer point on it, but I remember reading an interview with Fama, and I don't remember if it was after the 08-09 financial crisis, but he said, no, efficient markets doesn't mean that the price is always the true and intrinsic value. It's just that we don't know if it's not, and we don't know how long it's going to last. I mean, we may argue that the stock market today in the U.S. has reached some all-time highs, and one of the reasons clearly is low interest rates. But we don't know how long that's going to last, because we don't know how long the Fed is going to continue to keep interest rates low and things of that example. So, I mean, an analogy that maybe I think of when I think of efficient markets is we've used supply and demand as a static model. We've recognized that it doesn't mean we're always at P star and Q star, but the market would move towards that. I think efficient markets in the same sense, we might not always be at the true value, but there's going to be, if there's arbitrage opportunities, then we're going to move towards that intrinsic value.
I think that I would agree with all that. Markets are pretty doggone efficient at what they do. It's hard to beat them, as many of us can attest.
Right. Well, thanks for joining us for this episode talking about efficient market hypothesis and its implications. Hope to see you next time.